Hello everyone, I am Abhishek Agnihotri and currently I am pursuing PGDM from Pune Institute of Business Management with a specialization in finance. So today in this video, I'll be explaining on a very relevant topic in development finance, which is the limitations and challenges of MFI individual lending. So let's get started. Here is a quick roadmap of what we'll cover today. So we'll cover a quick introduction, 6 key challenge areas, and a comparison with group lending, and a wrap up with the recommendations and takeaways. So MFI individual lending means providing microcredit directly to a single borrower based on personal assessment, not a group collateral. So the scale is significant. 1.4 billion adults remain unbanked globally. MFIs manage a 124 billion US dollar portfolio serving 140 million plus borrowers, mostly in Asia and Africa. Clients are low income entrepreneurs, women in micro businesses and small farmers, and informal workers, people trading traditional banks won't serve. Despite this reach, individual lending faces deep structural limitations that we'll explore now. So the first challenge is cost. Processing an individual microloan costs 5 to 10 times more per user per rupee than a commercial bank loan, because every loan requires field officers to physically visit, manually document, and doorstep collect repayments. Fixed administrative cost spread over tiny loans amount of 10,000 rupees to 50,000 rupees create an unsustainable cost structure. To stay viable, MFIs charge 18 to 36% interest per annum, which ironically burden the very uh, borrowers they are trying to help. Second is credit risk. There are no collateral borrowers, have irregular income, and over 30% hold loans from 3 or more lenders simultaneously. More clients have no formal credit history, making risk assessment largely subjective. The result is NPA rates of 2 to 8% under normal conditions, speaking sharply during economic shocks or regional crisis. Third one is information asymmetry. Group lending uses peer monitoring to filter risky borrowers. Individual lending has no such safety net. This leads to first is adverse selection. So riskier borrowers apply more aggressively. Then more moral hazard. Funds get diverted to consumption with no monitoring, and loan officer bias, which is one person's judgment influenced by caste, gender, or incentive targets drive all decisions. And the fourth one is regulatory complexity. Interest rate caps at 26.5% protect borrowers but make remote lending unviable. Loan limits of 3 lakh rupees cap growth. Overlapping regulators like RBI, state acts, money lender acts, multiple compliance cost. And the biggest irony is strict KYC requirement end up excluding the most vulnerable borrowers who lack basic documentation. Fifth is social and ethical risk. Without group accountability, individual borrowers face more aggressively recovery tactics. home visits, social pressure, and public shaming. The 2010 Andhra Pradesh crisis, where 80 plus suicides were linked to coercive MFI collections, remains the most extreme example of what happens when commercial pressure overrides human dignity. Mission draft, mission drift is also real. As MFI commercialize, they shift toward moderately poor borrowers, abandoning the ultra poor they were designed to serve. And the sixth one is technology gap. No AI-based credit scoring, poor rural connectivity, incomplete bureau reporting, and low digital literacy among borrowers keep MFI operations manual, costly, and blind to over-indebtedness. Technology here is not just a challenge, it is the biggest untapped opportunity. So now let's talk about the comparison between individual and group lending. So this comparison table crystallizes why individual lending is inherently more challenging than the group model. Individual lending offers borrower greater autonomy, privacy, and larger loan size, but at the cost of higher default risk, higher per loan cost, and the loss of natural monitoring mechanism that group liability provides. Understanding this trade-off is essential when designing MFI products and policies. So, what's the way forward? Six key recommendations. One, deploy technology-led credit scoring using alternative data. Two, mandate universal credit bureau reporting to prevent over-indebtedness. 3. Design a graduated loan product that reward repayment performance with larger loans over the time. Fourth is invest in financial literacy programs so borrower can use loan productively. Fifth is adopt ethical recovery framework with grievance redressal system. And sixth one is advocate for a regulatory rationalization, one harmonized set of rule across all MFI categories. None of these are radical ideas, they are evidence-based interventions already working in markets like Bangladesh, Kenya, and the Philippines. So, to wrap up, MFI individual lending is a powerful tool, but it comes with real and serious limitations: high cost, credit risk, information gap, regulatory complexity, ethical concern, and tech deficits are not minor frictions point. They are structural barriers that must be addressed deliberately. As I leave you with this thought, microfinance is not a silver bullet, but with the right design, governance, and technology, individual lending can still be transformative force for equitable financial inclusion. So thank you so much. That's all from my side.